seems to be working, and I'm going to torture people by making them watch me on screen. That's even worse than watching me in person. So I'm going to kind of stay over here so it's in here. So this is about classifying cost, obviously. And when we talk about cost, we're talking mainly about inventory cost. Now I know a lot of you think, well, I'm never going to mess with inventory. I'm never going to be in a manufacturing setting. Maybe you're right, maybe you're wrong. You don't know where you're going to end up. So I feel like we need to walk through this because this is an accounting class and it might be the only time you hear this information. And of course you'll be tested on it if for no other reason. But when we're classifying cost, see if that's working today. Classify cost by cost objects. Distinguish between direct and indirect costs. Okay, we're going to focus on cost objects for a second. It just depends on your viewpoint. If we want to know how much it costs to run Trevecca, we got to be pretty high up and we have to look in their system. What's it cost to run the whole college? When you look at the Predators or any other or an NFL team, you know, if you want to know what it costs to run that organization, you got to look up here and get all the data, right? But then you want to know what does it cost per game? What does it cost to run that snack stand? What does it cost? It just depends on where you want to go. Let's come back to Trevecca for a moment. What does it cost to run this classroom? What does it cost to run the business department? So it depends on your cost object. What does it cost per student? And believe me, they know. Cost per student. I have no idea what it is, but they know basically. So, you know, what does it cost? It just depends on what you're looking at. What does it cost to make this table or that chair or the hat that's on your head? Somebody knows. Somebody knows. So it depends on what cost object, how small you want to get when we're talking about a cost object. It can be any activity or item for which a separate measurement of cost is desired. So it can be from the 50,000 foot view, or it can be a very detailed view, basically, for which a separate measurement of cost is desired. It can be an activity, a product, or a service. Product's pretty easy, a table, a chair, whatever it might be. You know, that's the cost of a product, and we'll get into that as we go. A cost of a service, somebody that's operating on you, somebody that's doing a website, somebody that's doing your tax return. You know, what does that cost, basically? What's it cost to put on a soccer event? What's it cost to put on a baseball event? You know, those are kind of services and activities. Activities and services are kind of the same thing. It could be a particular project. What's it cost to perform a project and then the project's over? A geographic region. If I'm a national company, I want to know what does it cost to run my Tennessee base? What does it cost to run all my Tennessee salespeople and everything that's happening in Tennessee? Or maybe in the southeastern area, or maybe in one country. So it can be by geographic. But to figure out the geographic region, you need to know the details, right? You have to start small, but you would get summary information about the geographic region. So it just depends on the viewpoint, and of course, by department. There's like the business department, like the printing department. You know, we even know what it costs to run the church. And then each of the organizations in a church, or healthcare is huge these days. Some of you will end up in healthcare probably. Hopefully not being worked on, but working for a healthcare company. And that's a great area to go into, you know, to think about getting into. We're going to have special speaker next, two really, you might even know them. Matthew Elliott, Mark Elliott's son, you know Matthew? And he's bringing Michael Blevin. Michael was kind of an All-American basketball player a few years back, and they work for Northwestern Investments. And they're just going to come and tell you what kind of opportunities are available, and they'll give you some ideas outside of sports management a little bit. And one of them may have majored in sports management. I'm not sure about that. But anyway, just good to get some new views in here, tell you about a little thing. But that'll be next Wednesday. I think it's next Wednesday, March 2nd. But anyway, the cost object is what we're worried about here. Now, what cost? Oh my, that's fancy, isn't it? Okay, so assigning cost to cost objects. We need to figure out which ones are direct and which ones are indirect. As you know, there's always usually a way to label something or to categorize something, and it's not always the same. So an indirect cost can be a common cost can be an indirect cost. So when we talk about direct cost of making something, when we talk about the direct cost of making this table or that chair, we know what went into that. How much plastic, whatever else goes into that, plastic and glue and whatever else goes into a particular table, steel, metal, whatever it is. Those costs are directly traceable. And we're going to get into direct labor, direct materials, and overhead here in a minute. But our indirect costs are a little different. Just think about this, just this building basically, okay? An indirect cost would be the electricity. Now my salary is a direct cost. But when you talk about the electricity and anything else we have to incur for this particular class, those are indirect costs, those are common costs. We probably know how much electricity this building uses. Probably, I would guess we do. There's probably a separate meter. We know how much electricity this building uses. But it's probably not worth figuring out how much this particular class uses. We probably don't trace it that closely because that's kind of expensive. And you have to have a sophisticated system for that. And it's probably not worth it. It's probably not worth finding out how much electricity this particular classroom costs. So that would be an indirect cost as far as the electricity is concerned, but my cost would be more direct for this particular class. We could figure out my salary for this class. So we have direct cost and indirect cost. We're going to get into a lot of those examples. But before we go any further, I do want to introduce the terms of direct labor and direct materials to you. Let's see, what was the name of that video we watched last week? Marcus, and he took us around and showed us all that stuff. What was it?
Profit.
The profit, and where did we go? Where did he take us?
To the bat place.
The bat place, yeah, the bat cave, right? He took us to the bat place. And they make the little bats and all that stuff, and then they tried to expand out, right? They went and created some stuff and went to Bass Pro Shop. Tried to sell them some stuff, so it's good. It's good. You remember some of that stuff. Well, basically, he didn't get into naming direct costs and all that stuff, but hopefully by visualizing a place where they make all that stuff, the direct cost would be any labor. Direct labor would be any labor that we can trace directly to a product. It just depends on what it is. Direct materials would be any materials we can trace directly to a product. You're not going to be able to trace everything. It just depends on your system, basically. And then anything else that has to do with the manufacturing process, we throw that in manufacturing overhead. We'll just call it overhead instead of just manufacturing overhead. We'll go ahead and call it overhead. Okay? And we're going to get into a bunch of that as we go, but that's just kind of an introduction to it. All right? But before we even get into that, let's make sure we understand what a product cost is. Any cost that you incur to get an asset ready for its intended purpose. Your assets reside on your balance sheet, as you know. And we've been through a little bit of cash and accounts receivable. So we also need to deal with our inventory. Now, if you're a bookstore and you go out and buy books and you mark up the price, that's a merchandiser, right? That's somebody who buys it up and marks it up and sells it to you. What do you think the markup is at the bookstore? I don't really know. You think it's really high? You think it's 100%? You think they mark them up 100% or something? I think it's about 25% or so. The last time I heard, I don't know what it is now. But anytime you just buy something, mark up the price, and sell it, you're a merchandiser. Companies that have to build something, they're a manufacturer. Does that make sense? So they've got to build it. Now, can you be both? Yeah, sure, you can be both. You can build stuff and sell it, and you can buy stuff and sell it. But either way, hopefully you're going to have a markup in there. So let's say you build something for $10. You with me? You build it for $10, or you buy it for $10. Doesn't matter. It doesn't matter. Okay, you build it for $10. And you want to mark it up 50%. You know what the price is going to be. You just multiply that by 1.50. So your price is going to be $15. So you just mark it up basically. Okay, now that's markup on cost. We'll get into markup on sales price in a minute. But anyway, product cost is the cost associated with making the product available or ready to sell. So up until the time that product is ready, all of the cost will go into the cost of the inventory. It will go into the cost of the inventory. Now, once that inventory is ready, and it's ready to sell, from that point on, it's going to probably be a selling cost. And your selling costs are expenses, okay? So your inventory is right here. If you're a merchandiser, you'll just have one inventory account. And if you're a manufacturer, you're going to have raw materials, work in process, and finished goods, and we'll talk more about that. But all of these are the cost of your product. And when you sell it, it's going to go to your cost of goods sold. And your cost of goods sold, that's your inventory expense. And you know that you subtract that to get your gross profit. And then, of course, you got selling administrative expenses. And we'll talk about period cost in a minute. So any product cost is an inventoriable cost. So picture it attaching itself. Picture how, picture a baseball. A lot of work goes into making that baseball. And all of the costs that go into that baseball attaches itself to that baseball. And that's a product cost. Once that baseball is ready to sell, from that point on, it's a different type of cost. It's going to normally be a selling expense. It's going to be a selling expense, and that's called a period cost after that. So
cost of goods sold is product cost, and then gross profit, selling, and other expenses are period cost.
You've got all your sales, you subtract your inventory cost, which is your cost of goods sold, those are your product costs. And then anything else is a period cost, basically. Now, which we're going to make that distinction here. Period costs are not considered product costs, okay? Your product cost is going to attach itself to that inventory account. It's going to get into the inventory account, and it's going to live on the balance sheet until you sell it. And then once you sell it, it's going to jump from the balance sheet to cost of goods sold. So those are your product costs. Now, what about our period cost? Our period costs are anything that we're just going to expense as it's incurred. You see, your inventory costs, they're kind of stored on the balance sheet until you sell it. But period costs are not stored anywhere. They're not put in any account except an expense account. And the reason they're called period costs is because they are expensed in the period incurred. Where some of our inventory, we probably won't sell all of that, right? There'll probably be some inventory we don't sell this period, so it'll stay on the balance sheet. But those that we do sell makes its way to cost of goods sold, and we subtract that because it generated those sales, and that's perfect matching. The cost of goods sold, we used our inventory cost to generate those sales. So that's perfect matching. When you sell something, you generate sales. And you're trying to match that expense with those sales in that period. So your period costs are either going to be selling or administrative, as I have demonstrated here. Those are our period costs. So once that asset's ready, it's to be sold. From that point on, it's not going to be stashed in the inventory account. If you can visualize that some way that will help you, putting it in a box or whatever. So once that asset's ready to sell, if we ship it out, that's a selling cost. If we ship it to our customers, that's a selling cost. Any administrative expenses that's incurred, think of accounting, think of IT, think of the president, think of VPs, think of the home office. Think of the home office with all those people working. They're not actually building the product, but we need them, right? We've got to have them. We've got to have them. So those are administrative costs, and those are period costs. And here's a few multiple choice. Let me suggest that from here on out, we're not going to rely on matching as much. So I don't know how that will affect your study time or anything, but we'll still have some, but it won't be 50 points on a test, okay? So kind of consider that as we go along. Did I give you one thing? Did you come late? So an activity or item for which a separate cost measurement is desired by management, okay? Straightforward, we just studied that. Which one is it? Somebody shout it out. Come on. We got Ryan.
Activity or item for separate cost.
What do we need? Anything we want for a separate cost measurement is called a
indirect
cost object. That was on the first one, wasn't it? So that cost object can be a piece of paper, it can be this glass, it can be a table, it can be a soccer event, it can be a snack stand. It just depends on what you want to measure. What do you want to measure is what we're after. What do you want to measure? For which of the following types of business would a service be a highly useful cost objective? So we want to cost a service. So which one of these is a service?
See,
Well, I could see maybe why you say C, but they're building inventory. They're building a bridge. That's really inventory. When somebody does surgery, that's kind of a service, isn't it? It's a service. And it's amazing how much they know about how much it costs to do a surgery. I had hip surgery December 30th. They had to revise one that they did 5 years ago. And I got my bill. I got the bill. This was just from the hospital. And it was over $30,000. The charge for the operating room was over $7,000, which I kind of get that, you know, the nurses and everything. Then they had a $15,000 charge for the St. Thomas Joint Replacement Center. You don't even know what that is. Nobody knows what that is, I don't think. And then that wasn't even the doctor's bill. The surgeon, I hadn't even got the surgeon's bill yet. Well, thank the Lord I don't have to pay for all that. You just couldn't. And they probably don't even pay. They probably pay about half of that. But believe me, the point is, those hospitals know what it costs them, down to the penny. You know, they'll charge you for plastic gloves that somebody uses, basically. So they know down to the penny because they have to stay in business. And a lot of health companies are now for-profit. It used to be most were not-for-profit, but a lot of them, like HCA, that's the biggest one, they're for-profit. And some people think, well, it shouldn't be, but for-profit organizations have a lot of advantages. I mean, they have, you know, their incentive is different, and they can provide services just as good, if not cheaper, basically. Anyway, a cost that is common to more than one cost objective. Now, that's going to be, it's indirect cost, but also put beside that in parentheses, a common cost. It's a common cost is an indirect cost. That's a cost that we really can't trace to a particular activity or cost objective. It's just not worth the hassle, basically. Okay? It's just not worth the hassle. You know, when you talk about one of these tables, it's probably got a bunch of glue somewhere, I would guess. They probably didn't trace all that glue. So that's an indirect cost. They probably estimated it in this part of manufacturing overhead. But they probably know how many man hours were spent on this and how much material went into it. They can trace that to a particular table. But it's hard to trace things like glue and stuff. So that's more of an indirect cost. Another term used to describe an indirect cost, again, right there it is, just mention that, that's a common cost. That's like the electricity for this building. The electricity for this building is a common cost. Here's Bud. We all like Bud. Bud has a chain of 5 grocery stores in the city. An example of a common cost for the 5 stores. Think about 5 stores. Colin thinks it's A. An example of a common cost for the 5 stores. Now, so when you talk about a common cost, is Colin right on that one? What's the answer? Which one of these can relate to all 5 stores? Does this one relate to all 5?
Nope.
Does this one relate to all 5?
Nope.
Does this relate to all 5?
Oh, it's gone.
So that's what you have to ask yourself when you talk about a common cost. So anything that relates to that individual store, that's a direct cost. Because we know that individual store utility cost was just for that store. That manager's salary was just for that store. The individual store cashier wages just for that store. So our common cost would be local television advertising. Also think about, they probably have a regional vice president of sales or marketing, or maybe a VP of the region. That cost would also be a common cost. That would be a common cost. Bringing it back to Trevecca a little bit, you know, Dr. Boone's cost, he doesn't make enough money, but his cost is a common cost. Very important, but he doesn't teach classes normally. So his is more of an indirect common cost. But when you work for a particular department, and in that department, that is a direct cost to that department. Bud's a small grocery store chain with 5 stores. What's an example of direct? You got that? Is he right?
Yes.
Wages paid to the store manager. But the point to get out of this, common,
Individual.
common.
So a common cost is a general, it's not individualized like a direct cost is.
Exactly. Exactly. And you know, when you go out and you're doing your thing, you're going to different stores, you're going to whatever, you know, look around and think about the different costs. I know it's not going to be an exciting conversation, if it's your first date especially, but, you know, think about the costs that are going on in a restaurant. Think about the cost that's going on in an athletic event. You know, a lot of different kind of costs. Another term used to describe a product cost, a period cost is what? Right here. Selling and administrative. That's a period cost, right? Selling administrative is a period cost.
So it's
Common cost.
common.
This one's a little confusing, but anything that's inventoriable is a product cost. Anything that attaches itself to inventory. That's the cost of the product. Now think about that, the cost of the product that you're buying, and if you have to pay freight to get it here, that's part of the cost of the asset. If you have to pay insurance while it's getting here, that's part of the cost of the asset, that's part of the cost of the inventory. So whatever it takes to get that asset ready, that's part of the cost of the inventory in this case. That's part of the cost of the inventory.
Let's see.
See. From the bookstore's perspective, freight in paid to ship books to the store is an example of a product cost, because we couldn't get them unless we paid to get them here.
Yep.
So that's part of the inventory, that's part of the product cost. That's part of the product cost. Okay? Now, if we were shipping this out to our customers, if we're shipping the books out to our customers, that's a selling cost. That's a period cost, because we expense that in the period that it incurred. You're getting it? You're getting it? A cost that is incurred by the firm that is not, encircle not, a merchandise cost. So which is not a merchandise cost? Okay?
None of them.
A cost that is incurred by the firm that is
They all
not. Let's see, is inventoriable cost merchandise?
Yep.
Product cost merchandise?
Yes. Period cost, nope.
No, so that's your answer. Because these are our period costs. Selling and administrative expenses are our period costs. Because we expense them in the period incurred.
Wait, say that again, selling and administrative. All right, administrative period.
An example of a period cost
See.
is not inventoriable, it's not a product, but it's selling. Manufacturing overhead is part of our inventoriable cost, which we'll get into more as we go along.
Break
But
it down.
that's a period cost. So anything that has to go through the balance sheet, it has to do with our inventory. It has to be here, makes a pit stop here, lives on our balance sheet until we sell it, and then we transfer it to the income statement because it's used up. You used it, you sold it, you used it. Title passed. Okay, freight out. Think about that. Freight, I gotta pay to get something out. Beautiful. But the way we're categorizing it's a little different. This is a product or period. So freight out is an example of what kind of cost, and freight in is an example of what kind of cost. So freight out is what?
Product.
Freight out is what?
Period.
I knew that
Because
one.
you're selling it.
And freight in is,
Product.
so that's the answer, right? No.
D.
I shouldn't touch that.
Why is it period?
Because it's straight out.
Yeah, because it's a selling expense.
Selling.
It's a selling
And
expense.
freight in is because it's
Freight
buying
in,
it. So
you're
it's
buying
cost
your
of
inventory, it
goods.
goes into the cost of your
Inventory.
inventory. You can't get it until you pay the freight. If you don't pay the freight, you can't get it. If you don't pay the freight, you can't get it.
Product.
Everybody likes to make commissions. Commissions paid on sales of a product can be classified as,
Administrative.
Period.
well, think about that. Why do you get a commission?
You sell something.
And what's,
It's an administrative expense.
So what's the number? It's gonna be period.
Well, why does it have administrative and period? That's tricky. That's a trick question.
Because administrative falls under period, right?
Yeah.
can be classified, that's true, it is a little, but it's a period cost.
Alright, I'll give you that.
Because it's a selling cost. It is not administrative. It's a selling cost. It's not administrative.
Oh, yeah.
So right beside a period cost, in parentheses, put selling. It's a selling cost. It's a selling expense. The cost of delivering the goods to the customers, a lot of these on here, is a selling cost. And that's a period cost. There's different ways to categorize different costs. We need to know both ways. The cost incurred by business to store goods that are ready to sell. And here's the key here. That are ready to sell. So if they're ready to sell, that means you're done building them, you're done buying them. Now they're just waiting around to be
Product
sold.
cost.
Inventory.
Product.
Inventory. How much you want to be?
Okay, all right, let me back up. The only costs that go into the inventory cost are costs to get it ready to sell. So once it's ready to sell, after that, it's going to be a selling or administrative, just depending, and usually it's selling. So basically,
So you're wrong too.
now notice this is a little different. We're storing the goods. That really doesn't have anything to do with selling, does it? So Colin, this is an administrative expense because they're just sitting there waiting to be sold. Selling expenses have to do with paying your salespeople, your advertising, all that good stuff. Those are your selling costs, your selling expenses. So if they're just sitting there waiting to be sold, that's an administrative
So in
cost.
the little picture,
What's that?
it's just administrative costs. There's not.
There's not a picture there for storing.
Alright.
But if you're storing, they're just sitting there basically, and so that's administrative cost. Where are we? Okay, possible distinction between product cost and period cost is based on whether the cost in question is. Is selling administrative? Yeah, not really. Is it inventory or product cost?
Yep.
Involves getting products ready for sale, involves the selling function itself? None of these answer. Between a product cost and a period cost. Now, is an inventory or product cost? Those are the same, right?
Yes.
Everybody got that now? Inventory and product, that's the same. That's the same. Is a selling or administrative cost? Those are both what?
Periods.
Those are both period costs. Everybody got that? Beautiful. Those are both period costs. Involves getting products ready for sale. So that's getting it into the inventory or the selling function. So that's the distinction that we've been given. So the answer is C, because getting products ready to sell is inventory cost. Once they're ready and then you're trying to sell them, that's a period cost. Because you're trying to get rid of them, you're trying to sell them. You're trying to sell tickets, you're trying to develop your audience, whatever.
What does WIP stand for?
That's work in process. Yeah, we'll get to that in a minute. Work in process. So, the wages of factory security guard. Okay, so this has to do with kind of manufacturing overhead. So let's pretend that this room right here, we're making tennis shoes. We bring in the raw materials. Colin starts it. He does his thing. It's passed all around. We do our own thing, and then when they're done, we take them out that door over there, and they go to finished goods, and then we try to sell them. Well, so any of those costs that we incur in here that are not direct labor or direct materials, anything that has to do with our manufacturing that's not direct labor or direct materials, we throw that in the manufacturing overhead bucket. So picture a big bucket up here, manufacturing overhead's written on it. If it's not direct labor or direct materials, then we throw it in there. Now, does the security guard work on the product?
No.
So we throw him or her into the manufacturing overhead bucket. Do the lights work on the product? The electricity doesn't actually work directly on the product. We need it, we gotta have it. So that would be manufacturing overhead. What about the security guard for the home office? That would be administrative expenses, wouldn't it? The security guard for the home office. So only costs that have to do with our manufacturing goes into our work in process account. So all of our inventoriable costs when you're manufacturing has to either be direct labor, direct materials, or manufacturing overhead. You're going to wake up in the middle of the night thinking about that. Oh, direct labor, direct marketing, manufacturing overhead. You're just going to be eating that up.
So is it period or administrative?
Which one? Oh, it's a product cost.
Oh.
Because it has to do with our manufacturing. Because we need a security guard, right?
Yeah.
We need a security guard. Everybody with me? So he's going to be in the manufacturing overhead bucket. Because he's part of our manufacturing. But if he was the security guard for the home office down the street, that would be an administrative expense. Because it doesn't have anything to do with our manufacturing. It has nothing to do with manufacturing.
So WIP, work in progress, is direct labor, direct materials, and overhead.
Exactly.
Security guard of your facility is considered overhead.
Exactly. Because we need them, but they're not
But they don't
working
directly
directly on the
work.
product. They're not working on the product.
If they directly work, so what if it was the wages of a factory line worker?
What do you think?
They work on the product.
So it would be direct
Direct
cost.
labor. Direct labor.
So that's still a product cost.
The product. When you're a manufacturer, listen, when you're a manufacturer, you have an inventory count called work in process. Some people call it work in progress, even whatever one you like, that's fine. But anyway, work in process. All the costs go through this account, and when you're done, then you transfer it to finished goods. Once it's ready to sell. So picture us, we're working on our tennis shoes, we get done. All of our costs are are in this account. When we get done, we take it out and transfer it to another account called finished goods. That's represented by the warehouse down the hall maybe. So when they're finished, we take them out, picture a big forklift coming, taking all the tennis shoes we made today, taking them and putting them in the warehouse, the finished goods warehouse. And now we're going to try to sell them. And those costs from that point on are selling and administrative. Those are period costs.
So overhead, is that only, so overhead are things in your factory that aren't direct, so like the electricity, wages of people that aren't, so like would like it's the salary of the manager or whatever be an overhead?
Exactly. We're going to get into all those examples. That's a great example. Let's say I'm the manager. You guys do all the work. I walk around and pat you on the back and make sure you're here on time. Make sure you got enough sleep. Make sure you got training. I schedule you. Now, I'm not working directly on the product. So my salary is going to go in manufacturing overhead. Because I'm not working directly on the product. So that's manufacturing overhead. What about the people, you guys make a big mess during the day. So when you leave, the cleaning people come in. Is that a pretty important thing?
Yeah.
Pretty important thing. They clean up after you. So that's not direct labor, that's manufacturing overhead. What about the people that clean up the home office? That's pretty important. The people that clean up the home office, that's an administrative expense because they're not dealing with the manufacturing. They're not dealing with the manufacturing. Good. As I mentioned earlier, okay, I mentioned this earlier, so this is a good place to repeat it. If you're just a merchandiser, nothing wrong with that. You buy material, you mark it up. You buy the product, you mark it up, whether it's tires or wipers or books, candy bars, whatever. You're a merchandiser. Think about all the vending machines. They're a merchandiser, right? You buy it, you mark it up, and you sell it. And hopefully the markup will cover all of your other expenses. So again, if we paid $10 for a product and we sell it for 15, that's a $5 gross profit, isn't it? $5 gross profit, or it's 50% of cost. Now, you gotta get this. This is 50% of our cost, isn't it? If this is our cost, and this is our sales price. I'm sorry, people watching this, you probably don't get this over here, but anyway, $15 sales price, $10 cost, $5 gross profit. Hopefully the gross profit's large enough to cover all the other expenses, selling, administrative, and give you net income, hopefully. Okay, this is 50% of $10, right? But what percentage is it of sales? It's a third, isn't it? So the point is, 5 divided by 15 is 33 1/3%. That's a third. So some people talk about markup on cost, and some people talk about markup on sales. So markup on cost is 50%, and markup on sales is only 33 1/3%. 5 divided by 15. If you're a company and you're talking to prospective customers and they care, they want to know your markup, this one sounds better, doesn't it? It's the same $5. It's the same $5, right? It's just how you express that. A markup on cost will always be greater because it's 5 divided by 10 versus 5 divided by 15. So markup on cost versus markup on sales price. Normally, when we're looking at an income statement, we talk about gross profit as a percentage of sales. But anyway, that's your little markup, that's your markup lesson for today. Okay, the flow of product cost. And this is a great graphical representation, a lot better than mine, but mine's okay. Okay, flow of product. Get your brain working, get some things in there. Okay, the cost of merchandise, which would be your purchase price, your freight in, if you paid in the insurance, whatever it takes to get that asset ready to sell, goes into the cost of the inventory on your balance sheet. Now, the cost of the inventory does not become an expense until when?
So,
And this is our expense right here. Everybody got that? Stick that, hit the enter button on that. Hit the enter button on that. Okay, once we sell it, it jumps to the income statement as cost of goods sold, and you might want to put in parentheses there, inventory expense. Well, why don't we just call it inventory expense? Well, it's such a substantial number, and it's usually the largest expense. We don't want to mix it up with utility expense and salary expense, so it gets its own special name, cost of goods sold. So whatever it costs us to prepare that inventory, that goes to the income statement, and whatever's left over at the end of the period is on the balance sheet in our inventory account. So think about this. Go with me here. We only have 5 minutes left. Whatever costs come through this door for our inventory. We may have had beginning inventory. So if we have beginning inventory plus any cost that's incurred throughout the period, at the end of the period, those costs either have to be on the income statement as cost of goods sold or on the balance sheet in the inventory. So it's either going to be on the income statement or it's going to be left over on the balance sheet. So what's left over on the balance sheet are those things you didn't sell, right? Anything you didn't sell is left on the balance sheet. Anything you did not sell, unless somebody stole it, we're not going to worry about that. That happens a lot. We're going to assume everything was sold. They're still there. Yeah, the percentages of our inventory that get stolen, it's just amazing. It's usually by employees, more by employees than shoplifters. But anyway, we'll get into some internal controls later. Goods sold, goods not sold. Now, I want you to be able to think through this. I want you to be able to do this on your test. There's no reason we can't do this. The cost of goods sold schedule. whatever inventory you started with, what about if you just started your business this year, then this would be zero, wouldn't it? If you didn't have it, if you just started, you wouldn't have it. Okay, we got 23 grand. So picture 23 grand of whatever you want to picture. Bats. How many bats or how much of bats did you purchase this year? Okay? And the amount that's in there is the freight in, insurance, whatever it takes to get that bat
Does
ready.
that include the raw materials?
Now, that's a different story. It depends on if we're just buying them and reselling them. If we have to create them like they did on the profit, they would have to take all their labor, all their materials, and all their overhead. Instead of being, it wouldn't be called purchases.
Okay, so
It
we're
would-
buying the bats.
It would be called cost of goods manufactured. I don't know if we're gonna get into that much of it. Yeah, but, so this is either gonna be purchases or cost of goods manufactured, but we'll leave that for another day. So we're buying the bats. That gives us goods available. Okay, hit the enter button, goods available. Goods available. If we had enough customers, we could sell all this, couldn't we?
Correct.
We could sell all of it. But we didn't have enough customers, so if you don't have a kind of updated accounting system, and you don't keep up with the exact inventories you sell it, you would have to stay up all night at the end of the period. How many of y'all have taken inventory before? Some of y'all work part-time for inventory takers, and Max, what'd you take inventory?
Under Armour.
Say again?
At Under Armour.
Under Armour, okay,
At
cool.
Opry Mills.
At Opry Mills? Was it late at night, or did you do it during the day, or
Late at night.
after it was shut down?
Yeah, we came in at like 9 p.m. and worked till 8 a.m.
Oh, really? Did you get it all counted?
No.
You
It
didn't
was
get
like
it
a
all-
week process.
And this is just a store.
Yeah.
I mean, that's just a store too. So anyway, it's pretty complicated to count. There are a lot of reasons you count your inventory. You want to see how much was stolen. But sometimes you have to use that final count to figure out how much you sold. So if they counted that there's $30,000 of Under Armour stuff left, that didn't get sold, did it? If it's still there, it didn't get sold. You see the logic? So you figure out what you could have sold, figure out what didn't sell, and you back into what you did sell. So what did you start with? What did you add? What's left over? Subtract it, and that tells you what you sold.
So the ending inventory is what you have left.
Ending inventory is what's left.
So say you have so at the end of 2004, you have $30,000 worth of bats left.
Yeah,
So that means you sold $293,000 worth of bats.
that's the logic.
Okay.
How much could you have sold? How much did you not sell? How much could you have sold? How much did you not sell? And that tells you what you sold. I know that's not real profound, but I want to stop there and make sure you can think through that. Now, we'll leave that for Friday. Thanks for your attention. Be sure you bring those handouts back, please. And no homework, but review this stuff. Please be reviewing it.